studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
One of the most useful year-end tax planning tools available to Canadian corporations is the bonus strategy built around the 180-day rule. This rule allows a corporation to claim a deduction for a bonus in its current taxation year, even though the bonus may not actually be paid until several months later. For many owner-managed corporations, this creates valuable flexibility in managing both taxes and cash flow. Let's begin on the left side of the slide. Imagine a corporation with a December 31st year-end. As the year closes, the business has earned $200,000 of profit. Rather than leaving all of those profits inside the corporation, the owner decides to declare an $80,000 bonus. Notice that the bonus doesn't have to be paid immediately. Instead, the corporation records the bonus as a liability called bonus payable. This means the corporation has committed to paying the bonus, even though the cash has not yet left the business. Now look at the calendar below. The corporation's year-end is December 31st. From that date, the corporation has up to 180 days to actually pay the bonus. For a December 31st year-end, that deadline typically falls near the end of June of the following year. This timing is extremely important. Now let's examine how the rule works. As shown on the right side of the slide, the first step is declaring the bonus before the corporate year-end financial statements are finalized. Next, the corporation records that bonus as an expense in its accounting records. Because bonuses are deductible business expenses, the corporation's taxable income is reduced. That reduction lowers the corporation's income tax for the current taxation year. However, the corporation is allowed to keep that deduction only if the bonus is actually paid within 180 days after the year end. If the payment is made on time, everything works exactly as intended. The corporation receives the deduction, and the owner receives the bonus according to the planned schedule. But notice the red warning box. If the corporation misses the 180-day deadline and the bonus is not paid within the required period, the corporation generally loses the deduction for that taxation year. In other words, simply recording the bonus is not enough. The bonus must also be paid before the deadline. This is why the clock, calendar, and tax return icons at the bottom of the slide are grouped together. Professional tax planning isn't only about calculating numbers. It also requires careful attention to timing. The amount of the bonus matters, but the payment date is just as important. Missing the deadline can completely eliminate the intended tax benefit. This strategy is popular because it gives owner-managers additional flexibility. Instead of paying the bonus on the final day of the year, the corporation can preserve cash for several more months while still obtaining a corporate tax deduction, provided the payment is made before the 180-day deadline expires. The key lesson from this slide is simple. A bonus declared before year-end can reduce the corporation's taxable income immediately, but the corporation must follow through by paying that bonus within 180 days. Professional tax advisors carefully monitor both the accounting entries and the payment deadline to ensure the corporation receives the full benefit of this valuable tax planning opportunity. In the next slide, we'll see how this timing rule creates a tax deferral opportunity and improves corporate cash flow without permanently avoiding tax. In the previous slide, we learned that a corporation can deduct a bonus before it is actually paid, provided the payment is made within 180 days after the corporation's year-end. Now let's see why this timing rule is such a powerful cash flow planning tool. The timeline at the top of the slide illustrates the entire process. Everything begins at the corporation's year-end on December 31st. Before the financial statements are finalized, the corporation declares a bonus for the owner-manager. That bonus is immediately recorded as a deductible expense. Because the corporation has now recognized the bonus expense, its taxable income decreases, reducing the amount of corporate income tax payable for that year. Notice that this tax benefit is received immediately. However, the owner does not have to receive the cash on December 31st. Instead, the corporation has up to 180 days after year-end to actually pay the bonus. Only when the bonus is eventually paid does the owner recognize the employment income and become responsible for the related personal income tax. This creates an important timing difference. The corporation receives the tax deduction now, while the owner's personal tax liability is effectively pushed into the following period when the bonus is actually paid. That timing difference is what we call tax deferral. Now let's compare the two situations shown in the middle of the slide. On the left, without bonus planning, the corporation reports all of its profit as taxable corporate income. Corporate tax is paid immediately, and less cash remains available inside the business. Now look at the right side. Instead of paying tax on the full corporate profit, the corporation declares a bonus before year-end. That bonus reduces corporate taxable income immediately. Even though the corporation still intends to pay the owner, the actual cash payment can be delayed until a later date, provided it occurs within the 180-day deadline. As a result, more cash stays inside the corporation for several additional months. This can provide valuable flexibility. The corporation may use those funds to manage seasonal cash flow, purchase inventory, invest in short-term opportunities, or simply maintain stronger working capital while waiting to make the bonus payment. The illustration at the bottom of the slide summarizes this benefit. The corporation retains the cash that would otherwise have been paid out immediately. During this period, those funds remain available to support the business. When the planned payment date arrives before the 180-day deadline, the corporation pays the bonus, and the owner includes that amount in their personal taxable income. It's important to understand that this strategy does not permanently eliminate tax. The owner will still pay personal income tax on the bonus. The strategy simply changes the timing of when tax is paid. That timing difference can significantly improve cash flow, which is often just as valuable as reducing tax itself. Professional tax advisors frequently emphasize that cash flow is the lifeblood of a business. A corporation with additional cash available for several months may have greater flexibility to invest, meet operating expenses, or respond to unexpected business opportunities. That's why the message at the bottom of the slide is so important. Tax deferral improves cash flow, but it does not permanently eliminate tax. The goal of the 180-day bonus rule is not tax avoidance. Instead, it is to give owner-managed corporations greater flexibility in managing both taxes and business cash flow through careful timing. In the final slide of this section, we'll examine how professional tax advisors use this strategy responsibly by monitoring payment deadlines, documenting bonus resolutions properly, and ensuring every compliance requirement is satisfied. We've now seen how the 180-day bonus rule creates valuable tax deferral and improves corporate cash flow. The final step is understanding how professional tax advisors use this strategy correctly while ensuring every legal requirement is satisfied. Let's begin with the planning process shown across the top of the slide. Everything starts before the corporation's year-end. The advisor first reviews the company's financial results and estimates the corporation's year-end profit. Based on those projections, they determine whether paying a bonus would help reduce corporate taxable income and improve the overall tax position. Once the appropriate bonus amount has been calculated, the corporation formally records the bonus as a payable before the financial statements are finalized. At this point, the corporation has successfully established the deduction. However, the planning process is only halfway complete. The corporation must now ensure that the bonus is actually paid before the 180-day deadline expires. When that payment is made on time, the corporation preserves its deduction, and the strategy works exactly as intended. Now look at the red warning on the far right. If the corporation waits beyond day 180, the bonus no longer satisfies the required timing rule. As a result, the corporation may lose the deduction for that taxation year, increasing corporate taxable income and creating an unexpected tax cost. This illustrates why professional tax planning is about much more than calculating numbers. Execution is just as important as planning. The advisor checklist in the middle of the slide highlights the key questions that should always be reviewed. Does the corporation have sufficient cash flow to pay the bonus when the time comes? How much personal income does the owner actually need? What personal tax bracket will the owner fall into after receiving the bonus? Is the bonus amount appropriate for both tax planning and business needs? Have payroll deductions and remittances been considered? Has the 180-day deadline been scheduled and monitored? And finally, has every required document, including the bonus resolution and accounting records, been completed properly? Each of these steps helps ensure that the strategy remains fully compliant while achieving the intended tax benefits. Notice the large countdown calendar beside the checklist. 180 days may seem like a long time, but businesses can become busy, priorities change, and deadlines are easily overlooked. Experienced advisors therefore build reminders into their planning systems well before the deadline arrives. The comparison table at the bottom left reinforces the difference between good planning and poor planning. With proper planning, the bonus is declared before year-end, paid within 180 days. The corporation receives its deduction, and cash flow improves. Poor planning tells a very different story. The bonus may never be properly declared. Payment may occur after the deadline. The deduction may be denied, and the corporation could face higher taxes than expected. Simply missing one important date can undo months of careful tax planning. Finally, follow the journey shown across the bottom of the slide. Corporate profits are reviewed. Bonus planning takes place. The corporation receives its deduction. The bonus is paid on time. The owner reports the personal income, and the result is optimized cash flow while remaining fully compliant with the tax rules. The most important lesson from this section is summarized in the final message. The 180-day bonus rule is a timing strategy, not a tax avoidance strategy. Professional advisors use it to improve cash flow, coordinate corporate and personal taxes, and provide greater financial flexibility, while ensuring that every legal deadline is met. When applied correctly, this strategy demonstrates one of the core principles of advanced tax planning. Success is not simply about reducing taxes. It is about carefully managing timing, documentation, cash flow, and compliance so that both the corporation and its shareholders achieve the best possible financial outcome.